ARM Holdings and Palantir Technologies are each benefiting from the rising effectiveness of artificial intelligence and the growing investments from businesses trying to deploy these capabilities. Palantir helps enterprises use their proprietary data to develop models that helps improve performance, while ARM Holdings has the patented technology that it licenses to many of these semiconductor chips that you see inside a lot of these AI data centers. So in this video, I'm going to compare these two AI stocks and answer which one I think is the better investment today by looking at their critical financial metrics, including revenue, cash flow, return on invested capital, the valuation, as well as looking ahead 5 years and seeing what Wall Street expects in terms of growth in earnings per share. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Starting with revenue, we can see each of these two AI stocks growing nicely over the years. Palantir with $2.5 billion in revenue in the most recent trailing 12 months. Interestingly, Palantir has found a way to re-accelerate revenue growth in recent quarters, which could suggest faster revenue in the future for Palantir. Meanwhile, ARM Holdings generated $3.5 billion in revenue in its most recent trailing 12 months, and the company's management team has forecasted between 20 and 25% revenue growth over the next several years. Looking at cash flow from operations to sales, we see similar numbers, but different trends. And with Palantir, the trend is improving with 28.58% in cash flow from operations to sales. That's up from around 10% in January of 2023. Meanwhile, ARM Holdings with 26.14% is coming down after being closer to 40% around August of 2023. So Palantir, not only with a better number, but also with the improving trend, it wins in this battle versus ARM Holdings in terms of cash flow from operations. The next thing I wanted to look at is the return on invested capital. This measures how good a company is at taking investor money and turning it into profits, and they are both improving on this metric. Palantir more quickly, and the number is better at 11.3% compared to ARM at 8.5%. Looking ahead, the analysts on Wall Street that are following ARM Holdings stock expect it will increase its earnings per share by roughly 31% each year over the next 5 years. Now, that rate of growth would be roughly triple the rate of increase of the median stock in the S&P 500, which would be excellent to be sure. That being said, the analysts on Wall Street that are following Palantir stock expect its earnings per share will be even better than ARM Holdings. They forecast that Palantir will grow its earnings per share at closer to 58% each year over the next 5 years. Now, this is actually down a couple of months ago. The analysts on Wall Street were expecting Palantir to grow its earnings per share at over 80% each year over the next 5 years. And I commented that that rate of increase is likely being overly optimistic. And I wouldn't be surprised if those expectations are downgraded, and they have been downgraded in recent weeks. Now 58% is still excellent, don't get me wrong, but it's a more reasonable estimate instead of the 85%, which is really, really strong. This would be 5 times the rate of the average stock in the S&P 500. But still, I think that's more reasonable for Palantir, given that it runs an asset-light business model. It's mostly a software company, and it's not going to need to invest significant sums of capital into the business. So 57% certainly more reasonable than 85%. And head-to-head, Palantir's expected growth rate is better than ARM Holdings' expected growth rate. Now, these two have solid balance sheets. What I have here is the net long-term debt. So this measures your long-term debt minus how much cash you have. And a negative number is good because that means you have more cash than long-term debt. And it's true for both of these companies. ARM Holdings has $2.5 billion in more cash than debt, and Palantir has $4 billion more cash than debt. In fact, Palantir has zero debt and just has this $4 billion cash balance. And that's good especially when you're a tech company, because tech companies are more volatile. The industry is more volatile, more opportunities arise. And so you want to have that strong balance sheet to capitalize on opportunities and withstand any kind of setbacks you may face. Now, one thing with tech companies is that some of them like to use a significant portion of stock-based compensation, and that has the impact of diluting shareholders, meaning existing profitability is split among more shares, so the earnings per share decrease because you have more shares. Palantir has been doing this extensively. It now has 2.4 billion shares outstanding. That's up from 2 billion shares outstanding in January of 2022. ARM Holdings also has been diluting shareholders, but not anywhere near what Palantir has been doing. Palantir uses a lot more stock-based compensation as a percentage of overall compensation compared to ARM Holdings. And finally, I wanted to compare these two on valuation, and I chose to use the forward price to earnings ratio to measure valuation for these two AI stocks. And these two are not cheap stocks. They're both on the expensive side. Palantir trading at a forward price to earnings of 85, while ARM Holdings trading at a forward price to earnings of 71. However, in certain key metrics, Palantir outperformed ARM Holdings significantly enough to make me suggest or to make me feel confident in paying a premium price for Palantir stock. Palantir had the better trends in cash flow, better trends in return on invested capital, re-accelerating revenue growth, and the expectations over the next 5 years were more robust for Palantir than for ARM Holdings. And the premium is not that much more than ARM Holdings. Difference of 15 forward PE compared to each other, 85 to 70. I think it's warranted to pay for Palantir. So if I had to pick one of these two AI stocks to buy today, I would pick Palantir instead of ARM Holdings. Still, acknowledging that each of these two stocks are on the more expensive side, which makes them a little more risky because you're looking at it as a risk versus reward. And if the price is already high, the potential reward is decreased because you're already paying such a premium price. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.